This is an analysis from Alpha Business Media.
Welcome back to the deep dive. For this analysis, our sources are pointing to an extremely tense moment in Nepal's economic story. It really feels like we're looking into two different economies running on parallel tracks that just never meet.
It's a perfect description, a total policy conflict. On one track, you have the official narrative from Kathmandu, which is heavily influenced by donors like the IMF.
Right.
And that narrative is all about fiscal discipline, stability, prudence, the standard global checklist.
It sounds great on paper, very responsible. But then you look at that second track, the reality in the industrial corridors, the workshops, and the story there is one of choked credit lines, orders that just vanish, and this pervasive grinding stagnation. Our sources call it a dangerous disconnect.
And that phrase, that dangerous disconnect, that's really the core of what we're digging into today. The commitment to austerity, the very thing that's supposed to secure international confidence.
We'll get that funding.
Exactly. That same policy is perversely stifling the most vital engine of the Nepali economy, the small and medium enterprise sector, the SMEs.
So our mission for this deep dive is clear. We need to analyze why the standard IMF playbook, this sort of one-size-fits-all austerity, is turning out to be a toxic prescription for Nepal's specific situation. And maybe more importantly, forecast what's going to force the inevitable policy pivot to a growth-first strategy.
And the really counterintuitive truth here, the thing you have to grasp, is that the very tool the international community fears, a measured strategic expansion of government spending, is precisely what the Nepali economy needs right now to break out of this trap.
Okay, let's start right there, that mismatch diagnosis. Because if the prescription isn't working, it must mean the doctors misidentified the illness in the first place. The source material is clear that the IMF remedy is for a very specific kind of patient, one suffering from a demand-driven overheating economy.
Exactly. When you have too much money chasing too few goods, that's when you bring in austerity. You cut spending, you raise interest rates, and you cool things down. But Nepal's illness is fundamentally different.
It's not overheating.
Not even close. It's suffering from profound supply-side stagnation, and that's compounded by imported, cost-push inflation.
So if the inflation isn't caused by Nepalese having too much cash to spend, what good are these high interest rates doing? Are they basically useless against the real problem, which is global commodity prices?
They're worse than useless. They're actively harmful. I mean, the inflation is being driven by the price of Brent crude, by fertilizer costs, by high taxes on imports. Squeezing the domestic economy does absolutely nothing to control those global prices.
Right.
It's a fundamental flaw, applying a demand-side cure to a supply-side sickness. The analysis compares it to putting a malnourished patient on a crash diet.
You get a stable-looking balance sheet, but you've basically starved the productive core of your economy to get it. And that leads us straight to the SMEs.
The SMEs are not just a part of the story. They are the backbone of the real economy. We're talking about an estimated 22% of GDP and, critically, over 1.7 million jobs. For these businesses, access to finance isn't for speculation. It is, as the sources put it, their oxygen.
And that oxygen is being cut off by a two-pronged attack, both stemming from this austerity push. Let's start with the first one, fiscal consolidation. How fast do government spending cuts actually translate to pain for these small businesses?
Oh, it's immediate. It's dramatic. When the government, which is the single biggest buyer in the domestic market, cuts public spending, it contracts demand across the board.
Instantly.
Instantly. Let's say the Ministry of Finance shelves a road building project. The pain doesn't just stop with the big contractor.
No, you're talking about a massive ripple effect through this whole domestic supply chain, which is almost entirely driven by SMEs.
Exactly right. Think about the entire ecosystem. The local quarry that supplies the gravel loses its contract. The small logistics firm that was going to transport it, their trucks are now idle.
The workshop fabricating steel, the cement dealers.
Even the local eateries that feed the construction workers. All that demand just evaporates overnight. That means the quarry owner can't service their loans, the logistics manager has to lay off staff, the government slows its tempo, and the pulse of the whole domestic economy just weakens.
And then piling on top of that fiscal freeze, you have the technical tightening from the central bank, the NRB. They're keeping monetary policy incredibly tight, high interest rates, strict credit to deposit ratios.
Yeah.
Why is that CD ratio specifically so punishing for the SMEs?
This is such a critical point. The NRB uses that CD ratio to manage liquidity, but what it means for commercial banks is that they have less free capital to lend. And when a bank is constrained like that, its internal risk calculation shifts immediately.
It shifts towards safety. So why would you lend to a small, risky furniture maker when you can just fund one massive, safe import trading house?
You've hit it exactly. Lending to a dozen small SMEs takes more staff time, more due diligence, and it carries a higher perceived risk than funding one huge collateralized import deal. Or, even simpler, just buying secure government bonds. The regulation forces banks to de-risk, and the SME sector is always the first to be cut loose.
The source used this really powerful image of a furniture maker. They have a full order book, real demand from retailers, but they can't get the working capital, that oxygen, to buy timber and pay their artisans.
And so that order book means nothing. It just becomes a piece of paper, a testament to lost opportunity. It creates this credit logjam where the capital exists in the system, but it's trapped. The banks are too risk-averse to lend it to the productive sector.
So the policies aimed at creating stability are actually, and ironically, creating total stagnation.
That's the paradox.
Okay, so if these policies are starving the productive sector, we still have to acknowledge why they're doing it. The IMF's extended credit facility is a big prize. It brings in foreign currency and that all-important seal of approval. But this brings us to the strategic errors. Let's break down why the standard IMF diagnosis is wrong on, at least 3 counts.
The first, as we've touched on, is the inflation type. It's a fundamental mismatch. Nepal's inflation is overwhelmingly cost-push and imported. Squeezing domestic purchasing power doesn't fix that. It just means fewer people can afford the higher prices. You're guaranteeing a recession on top of your inflation.
And the second error is that core overheating assumption. I mean, that's just demonstrably false, isn't it? An economy with chronically underspent government budgets, plummeting private credit growth, low industrial capacity, it's not overheating.
It's anemic. It's sputtering. The data on private sector credit growth, that oxygen we talked about, it's at historic lows. You don't cure an anemic patient by drawing more blood. There's plenty of room for demand to grow without spiking prices. The problem isn't too much demand. It's a total lack of confidence in capital.
Which brings us to the third, and maybe the most complex, misalignment. This weak policy transmission mechanism. The IMF model assumes a formal economy where you can pull the interest rate lever and behavior changes predictably.
But in Nepal, a huge chunk of the economy, maybe up to 40 or 50%, is informal. These are micro enterprises running on cash flow, not on sophisticated credit lines from major banks.
So when the central bank hikes the policy rate, what does that really do to the owner of a small workshop? It doesn't just deter them from taking out a new loan.
No, its primary effect is making it impossible for them to service their existing debt, or it cuts them off from microfinance institutions that get their funds from the formal system. The high-rate, low-spending policy mix fails them completely. It just drives them deeper into distress.
So the pressure's building. The choice is becoming stark. Continue with this slow suffocation of stability-first austerity, or embrace the volatility of a growth-first stimulus. To really get that choice, we have to look at the lessons learned right next door.
And Sri Lanka is the absolute cautionary tale of a growth-first strategy gone wrong. Colombo went for ambitious stimulus, big infrastructure, tax cuts, but the fatal error was financing it all with external borrowing in foreign currencies, mostly U.S. dollars.
So when their sources of dollars, tourism, remittances, when those collapsed, they had no way to pay back that external debt. And the result was sovereign default, currency collapse, just total destabilization.
The lesson from Sri Lanka is brutal and clear. A growth-first strategy funded by hard currency debt is suicidal for a country like Nepal that doesn't have a massive, world-beating export base to guarantee a constant inflow of dollars. You can't bet on money you don't have.
Okay, so let's contrast that with Bangladesh. They also pursued aggressive growth, but they managed to avoid that catastrophic trap.
Right.
How did they pull off that high-wire act?
2 key buffers. First, they built a phenomenal export engine with their ready-made garment industry. That provides a constant, guaranteed flow of foreign currency, which acts as a hedge. But second, and this is critical for Nepal, a huge portion of their public borrowing was domestic. It was denominated in their own currency, the taka.
And a government can't technically default on debt in its own currency, right? The risk changes. You're not worried about a foreign currency crisis anymore.
Exactly. The risk becomes domestic inflation if the central bank has to print money to finance the deficit, but you preserve your sovereignty. And that basically defines the strategic map for Nepal. Since it doesn't have that huge export engine, its growth strategy has to be internally focused. It has to be financed by domestic borrowing.
So issuing bonds to Nepali banks, pension funds, insurance companies?
Yes, but that manages the foreign currency risk while elevating a different risk: crowding out.
Let's just clarify crowding out for everyone listening. If the government starts issuing tons of its own high-yield bonds to fund projects, what does that do to the SMEs we're trying to help?
It can create a new kind of credit logjam. The government basically soaks up so much available capital from local banks that there's less left over for private companies and SMEs. They get crowded out of the credit market. So that's the trade-off. Avoid foreign default, but risk domestic inflation and squeezing out private investment.
But given the current crisis, the sources seem to argue that the growth-first risks are, I guess, the lesser of two evils.
They absolutely are.
Okay, so what does this all mean for the strategic outlook? The tension between the IMF's austerity plan and the reality on the ground is becoming untenable. Our sources are saying a pivot isn't a question of if, but when and how.
The forecast is for a subtle but decisive shift over the next 12 to 18 months, a shift toward a pragmatic, growth-first domestic stimulus. This won't be a big, flashy announcement. It'll happen through coordinated technical maneuvers designed to break the logjam without openly fighting with international partners.
And how will that pivot actually look? What are the specific levers the Ministry of Finance and the central bank are going to pull?
Well, first, you should expect the Ministry of Finance to accelerate capital expenditure. They'll find ways to justify spending money, to boost jobs, to finish vital projects, even if it technically breaches the deficit target. That gets cash flowing directly into the SME ecosystem.
And at the same time, the NRB will start to cautiously inject liquidity.
Yes, they'll ease the suffocating monetary policy. That could mean relaxing the credit-to-deposit ratio, which would instantly free up capital for banks to lend. Or it could be targeted refinancing schemes aimed specifically at agriculture and SMEs to break that specific logjam we talked about.
This really is a high-wire act, then. Because the hard truth is that the immediate consequence of all this will be higher inflation, won't it? And probably pressure on the Nepali rupee.
It will. That's the unavoidable trade-off. The strategic bet is that this higher inflation is a temporary price worth paying. The hope is that the stimulus reignites that SME engine, which creates jobs, boosts domestic production, and ultimately broadens the tax base.
So you achieve debt reduction through growth, not through an austerity that just guarantees stagnation.
That's the goal. And for you, as a business leader or just an observer, this means the era of suffocatingly tight credit is closing. You need to recalibrate your strategy now. You're moving out of a low-demand environment into one with higher inflation and probably higher interest rates, but critically, a revival in domestic demand.
So this analysis really gives you a clear sense of that core tension. It's the choice between the slow grind of stagnation and the necessary volatility of a growth-first stimulus. And it seems all the pressure is pointing toward action and, yes, volatility.
And as you think about this pivot, here's a final thought to chew on. This whole growth-first strategy is designed to stimulate the formal SME sector through these technical financial maneuvers. But we already acknowledge that the policy levers don't connect well to the vast informal economy. So how will this high-wire act affect that huge, unorganized part of Nepal's economic life? Will the rising tide lift them? Or will the domestic inflation and potential crowding out create brand new risks we haven't even seen yet?
A fascinating question, and one that highlights the complexity of managing a dual economy. That's a wrap on this deep dive. We hope this analysis helps you anticipate and navigate the strategic shift that's coming.